Do you know that 7% of American adults, that's 23 million people, think that chocolate milk comes from brown cows? That is an absolute fact. Nothing but the truth here, folks. Today's video is all about first-time homebuyer mistakes and how to avoid them. If this is your first rodeo as a homebuyer, or if it's been many years since you last bought a home, knowledge is power. Along with knowing where the pitfalls are, it's important to know what to expect and what questions to ask. Meet me on the other side and I will share with you 10 first-time homebuyer mistakes to avoid.
All right, here it is.
Welcome back, everyone. If we have not met, my name is Mark. Let's get it on.
Let's get it on.
Buying your first home comes with many big decisions, and it can be as scary as it is exciting. It's easy to get swept up in the whirlwind of home shopping and make mistakes that could leave you with buyer's remorse later. Not only will I give you the 10 mistakes first-time home buyers commonly make, but I will also provide you with how to avoid them. But you gotta stay. Number 9 and number 10, they're the most important because those mistakes are the ones that could jeopardize your new home purchase. Let's go.
Let's do this, everybody. Here we go.
Mistake number 1, not figuring out how much house you can afford. Not knowing how much house you can afford can result in wasting a lot of time. You could end up looking at houses that you can't afford yet, or visiting homes that are below your optimal price level. For many first-time home buyers, the goal is to buy a house, get a loan with a comfortable monthly payment that won't keep them up at night. Sometimes it's a good idea, folks, to aim a little bit low.
Very low.
How to avoid this mistake? Use a mortgage affordability calculator. You can find them online to help you know what price range is affordable, what's a stretch, what's aggressive. Better yet, get pre-approved with a lender so you have clarity, and then, we'll cover that information shortly.
And I thought to myself, I want that.
Mistake number 2, getting just one rate quote. Shopping for a mortgage is like shopping for a car or any other expensive item. It pays to compare offers. All lenders are not created equal. Brokers are not banks. Banks are not direct lenders. Mortgage interest rates vary from one lender to the next, so as do fees and closing costs and discount points. But according to the Consumer Financial Protection Bureau, almost half of the borrowers out there don't shop around for a loan. How to avoid this mistake? Apply with multiple mortgage lenders. A typical borrower could save $430 in interest just in the first year by comparing 3 to 5 different lenders. This is key. All mortgage applications made within a 45-day window will count just as one credit inquiry. A quick footnote, I spent 20 years in mortgage banking, and let me say this. Direct lenders have enough bid volume to offer you lower rates, less fees, all the programs that you need, and the underwriters make the final decisions. Go with the direct lender, folks. Get pre-approved before you start looking at homes so you know what payment fits your budget. And being pre-approved will put you in position for when your home does reveal itself. Mistake number 3, not checking credit reports and correcting errors. Mortgage lenders will scrutinize your credit reports when deciding whether to approve a loan and what interest rate. If your credit report contains errors, you might get quoted at a much higher rate than you deserve. That's why it pays to make certain that your credit report is accurate. How to avoid this mistake? You may request a free credit report each year from each of them 3 main credit bureaus. This is a must. Dispute any errors you find. Your credit's like Willy Wonka. It's the golden ticket in life. And having good credit presents many options for you and your family. Make sure all is in order. Mistake number 4, making a down payment that's too small. You don't have to make a 20% down payment in order to buy a home. Some loan programs enable you to buy a home with 0 down or 3.5% down. Sometimes that's a good idea, but homeowners occasionally have regrets. In a survey commissioned by NerdWallet, 1 in 9, it's 11% of the homeowners under the age of 35 agreed that they wish they put more money down. It was one of the most common regrets that millennial homeowners had, but the majority had no complaints. How to avoid this mistake? Figuring out how much to save is a judgment call. A bigger down payment lets you get a smaller mortgage, giving you more affordable monthly house payments. The downside is taking the time to save more money. And when home prices and interest rates have been rising, that means it could be more difficult to buy a home when you want. You may miss out on building some home equity as home values are increasing. The key is making sure your down payment helps you secure a payment that you're comfortable making each and every month. Purchasing a home is always better financially than renting. Mistake number 5, looking for first-time homebuyer programs. As a first-time homebuyer, you probably don't have a ton of money saved up for your down payment and closing costs. I get it. But don't make the error of assuming that you have to delay your home ownership while saving for a huge down payment. Not the case. There are plenty of low down payment loan programs out there, including state programs that offer down payment assistance and also competitive mortgage rates for first-time home buyers, and some of these programs can assist you even if you previously purchased a home. How to avoid this mistake? Ask a mortgage lender about your first-time home buyer options and look for programs in your state. Maryland has an awesome Maryland mortgage program referred to as MMP, and there's also the private Chenoa down payment program available. You might qualify for the U.S. Department of Agricultural loan, or one guaranteed by Department of Veterans Affairs, also known as a VA loan, that doesn't require any down payment. FHA, Federal Housing Administration loans have a minimal down payment of 3.5%, and some conventional loan programs allow down payments as low as 3%. You have options, folks, because the programs do exist. My niece Lauren, she purchased a home using a no down payment program in Westminster out in Carroll County, and we were able to negotiate for the seller to pay all her closing costs. Lauren only had to pay for her inspections. Again, down payment programs exist and they can help you with closing cost loans. They're all available for first-time home buyers and for those that previously owned a home. Mistake number 6, ignoring VA, USDA, and FHA loan programs. A lot of first-time home buyers want to or need to make a small down payment, but they don't always ask or always look for the details of government programs that make it easy to buy a home with zero or little money down. How to avoid this mistake? Learn about the following loan programs. Knowledge is power. Here are the basics. VA loans are mortgages guaranteed by the U.S. Department of Veterans Affairs. They're for people who served in the military. VA loans their claim to fame is that they allow qualified home buyers to put 0% down and get 100% financing. Borrowers they'll pay a funding fee in lieu of mortgage insurance. USDA loans can be used to buy homes in areas that are designated rural by the U.S. Department of Agriculture, zip code specific. Qualified borrowers can put 0% down and get 100% financing. You pay a guaranteed fee and an annual fee in lieu of the mortgage insurance. FHA loans allow for down payments as small as 3.5%. The Federal Housing Administration can be forgiving of imperfect credit. When you get an FHA loan, you pay mortgage insurance for the life of the mortgage, even after the mortgage has been paid down and you have 20% equity. I know this is a lot of information, but it's also the biggest investment of your life. Knowledge is key. One thing for certain now, the move to your new home does not have to be chaotic. Down below is my free moving guide. It's free and it will help you stay organized through your move. Check it out, people, down below. Mistake number 7, not knowing whether to pay discount points. Mortgage discount points are fees to pay upfront to reduce your mortgage interest rate. Interest rate savings can add up to a lot of money over the life of a mortgage, and discount points are one way to gain those rate savings. And if you're in the right position to purchase them, it takes cash though. How to avoid this mistake? If making a minimal down payment is the goal, the choice is simple. Don't buy discount points. If you have enough cash on hand, the value of buying points depends on whether you plan to live in the home longer than the break-even period. That's the time it takes for the upfront cost to be exceeded by the monthly savings you get from a lower interest rate. Mistake number 8, emptying your savings. I see this often. If you buy a previously owned home, it almost inevitably will need or have unexpected repairs not long after. Maybe you'll need to replace a hot water heater or pay homeowner's insurance deductible after bad weather. It's a growing pain for first-time homeowners out there. When stuff breaks, it happens. It's easy to find yourself in a hole quickly if you don't have enough saved for emergencies. How to avoid this mistake? Save enough money to make a down payment, pay for closing costs and moving expenses, and take care of repairs that may come up. Lenders will give you estimates of closing costs, and you can call around and get estimates on moving expenses. Keep your eyes wide open. Don't be shy to ask questions. Mistake number 9, applying for credit before the sale is final. The time frame between the day you apply for a mortgage and the day you get your keys to your new home are critical. You want to leave your credit alone as much as possible. It's a mistake to get new credit cards, buy furniture or appliances on credit, or take out an auto loan before your mortgage closes. Here's a true story. I had a client, not even funny, I had a client that was denied their financing on their new home because they celebrated right after their offer was accepted by purchasing a new red Lexus to match the color of the front door. Kid you not. True story. And their loan was eventually denied because their car payment exceeded their loan qualifications for a new home. It was heartbreaking to say the least. Don't do nothing with your credit while you're under contract to purchase a home. Don't do nothing. Here's why. Lenders' mortgage decision is based on your credit score and on your debt to income ratio, which is the percentage of income that goes towards your monthly debt payments. Applying for a credit card can reduce your credit score a few points. Getting a new loan or adding to your monthly debt payments will only increase your debt to income ratio. Neither of those is good from the mortgage lender's perspective. Within about a week of the closing, the lender will they're gonna check your credit one last time. And if your credit score has fallen, or if the debt to income ratio has gone up, the lender might change the interest rate or find a reason to, or the fees of the mortgage. It could cause a delay in your closing or even result in a canceled mortgage. How to avoid this mistake? Wait until after the closing to open new credit accounts or to charge furniture, appliances, or tools to your credit cards. It's okay to have everything picked out and lined up ahead of time. Just don't buy them on credit until after you have the keys in your hand. If you're considering it, talk to your lender. Let them guide you through the process. Mistake number 10, underestimating the cost of homeownership. The number one way to create wealth in America is through owning real estate, but you have to go in with your eyes wide open. If you buy a home, the monthly bills can stack up unexpectedly. This can come as a surprise if you're not ready. It's not just your mortgage payment that's going to be coming in the mail. You might have an oil bill, a gas bill, you're going to have a cable bill. You're going to have all these things that the bank doesn't care about when you're qualifying for a mortgage. Renters have the same bills, but the surprise is with a new home, you can have higher costs. It might come entirely with a new set of bills such as homeowners association fees, and of course the new Bomb TV or surround system that goes perfect in that living room. It's easy to get lost in the excitement of your new home. Be mindful of your budget. It all gets done. How to avoid this mistake? Work with your realtor who can tell you how much the neighborhood's property taxes and insurance typically cost. Ask to see the seller's utility bills. Some counties require it for the last 12 months. If the home was occupied. Just so you have a better idea of how much utilities is going to cost you. Or better yet, contact the local utility company. They will provide you an average over the last 12 months if it's been occupied. They will help you. Don't forget our awesome free moving guide down below, and you know it. I love you, Baltimore.